Everything too.
All right, Russ, we're live, my friend. By the way, can I be the first to say live, happy birthday to the idea guy?
Thank you, man.
Right?
Thank you.
If you're seeing this live, give a shout out to Russell, the idea guy Morgan, in the chat. Let him know that you got some birthday love for him.
Hey, I got my green on, man. I can't tell if your shirt's green. What color is that shirt? Is it white?
No, it's white, but it's got green lines on it.
There you go. Well, top of the morning to you.
Ah, thank you. By the way, did you get the senior citizen card in the mail yet today, or does it come later today, or how does that?
Hey, man.
I don't.
I'll take any discount I get. If they'll give me a discount for that kind of stuff, I would do it for sure. Well, we appreciate you listening to the podcast and watching us on YouTube. Every single month we come here to share what's going on in the passive income space as it pertains to what we've been working on. And today we're going to share some nuggets. So we're going to get ready to go live for our podcast, and this will air in a couple of weeks. But as you get to watch live, you get to actually see before anybody else does what's happening. So thank you for always supporting us and giving us feedback as we continue to learn with you. All right, Stallion, you ready to start the podcast?
Let's do this thing.
All right, Stallion, we got a lot to cover today as it pertains to what's going on in the world of finance, right?
That's
Banks
right.
are failing. SVB is in Chapter 11. That's having ripple effects throughout the financial markets. It's creating a lot of concern, right? People are wondering, hey, what I thought to be safe right now doesn't feel so safe anymore. What should I do? So we need to touch on that. We need to talk about what we are doing in light of that, right? Because we've talked about using lines of credit, which is actually using banks. Does that pose a risk to us?
That's right.
We love that infinite banking helps us stay out of the fray. It allows us to have access to cash. But then how does that measure up when we're tying it to banks? We need to make sure we address that risk, because there is a risk when you talk about what it is and how to mitigate it potentially. And then let's also talk about things that we're doing this year. Like how are we taking all of this chaos in the market and finding ways to use experience just to add into new sectors? Is that cool?
Absolutely. And by the way, don't forget, we need to address the FDIC issue. There's so many people throwing around this FDIC as if it is, well, good news is we have FDIC, and I want us to address why that may or may not be 100%, something to fail back on.
Okay. All right. Where do you want to start? I'm gonna let you lead here, because I don't know. I have a tendency to take us and derail us. Where do you think we should start?
All right. Well, number one, I think we just need to address, first of all, the issue. You and I are not experts on the way that the bank situation is unfolding. It would be impossible, and I don't want to mislead. Like we have just been on the receiving end of learning about these things. We've known that there's something that's underlying in this sector that has not been healthy for a long time. So I'm not surprised, and nor are you, that there has been some upheaval. But we don't want to pretend like we have like a crystal ball and know exactly how this is going to unfold. But I do think that we should address it from the standpoint of what do people need to do as a result, and then what are we learning real time on how it could or could not affect you. I think that we should start there.
Well, just some basics, super high level. This is not the actual technical thing, but I think for the purposes of our discussion, I'm going to lay it out simple. If you haven't really understood what's happening to the banks, why are these banks failing? Here's a very simplified approach to what's going on. One, banks have to have deposits in order to lend against those deposits. Those deposits then act as capital for the bank, and then they go out and lend money to everyone else, and that's how they make money, right? Banks have a liability to us as depositors, and then their asset is when they're lending money. And there's ratios that govern how much that they can do it. And I think it's like 10-1. Now that number can get inflated over time because as those payments come back to the bank and from those loans, they actually now those loans sit on the bank's deposit in their accounts, and then they can start lending against those. And so it really can get much greater than that. Well, banks have to take those deposits and they just don't sit on cash. So that's why, the old days of, going and robbing the bank, Willie Sutton, why do you rob banks? He's like, well, because that's where they keep the money. But that's not really true anymore, right? Like you go down to the bank, I don't know what's in any given bank, but my guess it's way less than like 100,000. It is not that much money at all. So where do they put their cash? Well, they're having to go out and buy bonds, usually treasury bonds, and a large of the banks over the last couple of years have been buying treasury bonds, 10-year bonds. Well, simple background on how a bond works. If I buy a bond for $1,000 and it's giving me a 2% coupon rate, that's the interest rate, right? So I'm getting this payment every single year for the 10 years. And then at the end of 10 years, I'm going to get my $1,000 back. Well, that's great. Now, what's happened is interest rates have risen. Let's just pretend they went from 2% to 4%. Well, now if I hold the bond, I'm going to get 2% and I'm going to sell it for $1,000 at the end of 10 years. But if for any reason I need to sell the bond today, I'm competing against bonds that are selling and paying 4%. So I'm not going to be able to sell Stallion my bond for $1,000, am I?
No.
I'm going to have to sell it for a discount. I'm going to have to sell it for 800, 700, depends on the math, right?
Right.
Well, so that's really what just happened to SVB. SVB was sitting there. The loans that they had outstanding was way up here. Their deposits were here, and the deposits kept going down. And so that gap got wider. So they were forced to say, we have to raise capital. So now in order to do that, they have to sell off those bonds. Well, as soon as they go to sell those bonds, they're worth 60 cents on the dollar. Well, now what was on the balance sheet was $1, now 60 cents. And we're talking in billions of dollars. So then 2 days in a row, the stock nosedive like 60%. And everybody else says, wait a second, I got my money at that bank. That bank's getting ready to go under. What do? I better go get it. And so they literally pull a, example. What's the holiday movie we all watch with the run on the bank? It's a Wonderful Life.
It's a Wonderful Life. Yeah.
You remember that example where it's everybody's there and he's like, I don't have your money. Your money's in this person's house and your money's over here in this. Well, that's what happens. And so now they get all the little money that's there and they have to shut the doors. Well, that creates an environment of uncertainty. And now we all start questioning, what do we do with money? And now all of us who've put money in our life insurance policies for all these years are going, how's that going to impact the insurance company? So Stallion, how does all of this crisis impact the insurance companies in your understanding?
So in my understanding is that the insurance companies are dramatically more safe place for our money to be stored because they do not operate under the same fractional reserve banking guidelines. Like you just mentioned, a 1-to-10 ratio. I can lend out $10 for every dollar I have on deposit. That is not the case with insurance companies. They are regulated at a much higher, how would you say it, level. Like they have to keep at least $1 for each dollar in deposit in reserve. And many of the insurance carriers that we've worked with over the years have well more than that 1-to-1 ratio. And so that gives us a lot of, like, let's just say this in the back of my brain, I'm talking this out and saying, well, what is the worst case situation in a bunch of like the financial sector failing? Well, at the very least, the insurance company is the last thing to fall. It doesn't mean that they are completely isolated and could not have anything happen to them, but they are going to be, based on just the pure way that they operate, they would be one of the last things or institutions to fall. And even in past history, if there has been an insurance company to fail, it's been very rare, But in that event, they've had a larger company come and take them over. With, essentially keeping your contracts in place and maintaining those essentially as grandfathered in from the previous carrier. So that to me is giving me first of all, and this is not just from you and I. This is from the clients that we've worked with over the years are reaching out to us proactively right now saying, I am so grateful I've set up this system of all these policies for my family, that I have the liquidity, I have the safety, all the things I was looking for are now becoming like more and more important to me, seeing all these banks failing around me.
Well, so give you a little more context to that. So banks can lend up to 10 times for every dollar they have on deposits. Insurance companies cannot. No one else can. It's illegal to do that for everyone else except banks, right? So that's the reason why insurance companies are more solvent. That's why you don't find insurance companies failing, is because they don't have this debt to equity ratio like SVB had 185 times the amount of money on loan outstanding than they had for a deposit. $185 was lent out. That was their total liabilities against their shareholder equity. That's a really big number, right? So insurance companies can have that. That's one of the reasons. So for us, we do hold lots of cash at the banks. Now, I do want to address something though, Stallion. You and I have been talking about our passive income operating system. And if you haven't already downloaded the ebook, go to wealthwithoutwallstreet.com/PIOS and take a gander at that. This is the process of how you turn active income into passive income. Now, within that, though, we talk about something that we do, which has been utilizing a life insurance line of credits, where we went to a bank and we said, hey, Joey and I have over 40 different life insurance policies. We insure like over 15 lives, something like that. And we want to simplify our life by not having to go take loans from every single insurance contract we have when we want to invest in a multifamily deal, or if we want to do more land flipping, or a short terminal, or Joey needs money to shore up, 100 unicorns balance sheet, whatever it may be, right? It made it simpler for us to have one checkbook that gave us the ability to write off all of those insurance contracts combined. Now, it was actually one. Joey and I know we share the same brain. We don't share the same bank accounts. So we have multiple different lines. But one of the things that came up through this process is we started evaluating the potential risk of having our life insurance companies, the contracts we have, collaterally assigned to these banks to have the line of credit. What would happen if the bank in which we were using for our line of credit went into bankruptcy? How long would that tie up my access to cash? So Joey, what have we found out in this process of trying to go through and figure out what sort of risk are we taking, and do we need to exit that approach?
Well, and so just as a little background, all of our liquidity are in insurance policies, right? There is no like, oh, we have, some money in insurance policies and some in these brokerage accounts. Like, we're Wealth Without Wall Street. Okay. We have nothing else besides our investments that are off of Wall Street and this reservoir of cash that is in policies.
Can I scrub your language there? Because I do want to be, every time we talk about this, I want to make sure the person who's listening to this for the first time, we don't have not $1 in a life insurance policy. There's not one single dollar in any life insurance policy. Where's that contract, the policy that they send you in the mail, or it's in your inbox? How much cash is in that policy?
Nothing.
Zero. Our money's where?
At the insurance company.
At the insurance company, right?
Okay.
That's what we're invested in.
Thank you for busting my nuggets on that unnecessarily, but I appreciate it. The point is, all of our liquidity is in there. So we think about this in the sense of, if that line of credit were to get seized, shut down, shut down is not a big problem, because they would just issue the collateral assignments back to the insurance company. They would be lost, and we would just do business directly with the insurance company for loans and everything else. But in the event, Russ brought this up to me about a week ago. What if they went into bankruptcy and that line was just stuck? We couldn't get access to it. We couldn't update it. We couldn't, like, if all that stuff was stuck for any long period of time, we would be in a lot of trouble. And so actually, I talked to the bank that we work with, and I said, wait a minute, what would happen in the event of a bankruptcy at your bank? And would those collateral assignments immediately go back, be lost, and I go directly to the insurance company? Is there any language about that? And he said, no. He said, but he reminded me of something that happened back when I was at Wells Fargo in 2008, 2009. All these banks start failing. What happened? The bigger banks, the regulars come in, take over, like seize the bank. And within a matter of days, that bank is now under or has been sold to, or I guess swallowed up by a larger bank. Those deposits, those liabilities, everything else that goes with that bank goes to the new bank. And he gave the example of BB&T Bank taking over Colonial Bank. That was here locally in Birmingham. I got to see that firsthand. He said in that situation, the bank literally took 2 days where they were offline, so to speak, and they still operated, but they asked their depositors to give them a couple days to work this out. And then everybody stayed on that worked there. All of the terms and conditions of the loans and things that were on the books stayed the same, even though there was new ownership in place. And he said, so there may be, if there was ever a bank failure with the line of credit that we have, there may be a short window of time, just like he explained, where the new bank would have to take over, and that would be kind of seized or you couldn't touch into it or whatever, but it wouldn't be a long-term thing. Now, I'm taking that with a grain of salt, Russ, just so you know. And I'm saying, okay, that does remind me of what happened back then. That doesn't mean that would happen the next time. So I'm not necessarily just taking that as the gospel and saying, oh, well, this is what would happen. But I am trying to, what?
Well, I was going to say, I want to draw a picture here. Not a pretty picture. And this is why you watch this on YouTube,
okay.
right?
Okay.
So that you can visualize this. Because for those of us who are very visual, like me, what Joey just said may or may not make sense. So I want to clarify what's happening, and then let's talk about what the potential risk is, because we always need to understand what the risk is so we can make good financial decisions behind it. Well, this is what we were talking about before. We make premium into life insurance policies. We have all of these insurance policies that are out there, and we have 40 something, right? And those deposits are made into insurance companies. And we work with 6 different insurance companies, Joey. We have life insurance contracts with over 6, I think it's 6, and maybe 7 now, I can't remember. And what we have done is normally, right, before we learned about this strategy, if we wanted to take a loan, we would go to the insurance company. They would use the cash value that was in these insurance contracts and say, yeah, we'll loan you money against that value, and they would just deposit it in our own personal bank account, and we would go, and it was fine, right? And especially when we had 1, 2, 3, 4 policies, like it was really simple. If I needed 200,000 and only had 50,000 in each one, I'd have to take a loan from all 4. Right? If I only needed 50,000, I could just take it from one. But it got to the point where when we started, with all of our cash, when we started buying assets, right? When we started creating cash flow, it's like, well, okay, the time that we took 3 loans from 3 different insurance contracts, we have loans against 3 different insurance contracts, and we're sending back $1,000 a month. Do we just send back a third? But, actually we end up taking 50 out of one and 25 out of the next 2. It just made our lives harder. And what happens when things get harder? You do less, right? Inaction, you get confused, right? We get complacent. And the whole purpose of the passive income operating system was to speed it up, because our goal is to get to where our financial freedom is defined when we have more passive income than we have monthly expenses. True?
That's right.
Well, so the way that we did that is that we went to a bank who said, yeah, I would happily give you a loan against all of the cash values that you have at these different insurance companies. And we had to fill out paperwork, get our spouses and other things. And we were able to combine it, which simplified our life even that much further. Because Joey, I don't know about you, but my wife owns a couple insurance policies. And having to have her sign the paperwork every single time, we were taking a loan to go buy something new. What if she wasn't there? What if she was on vacation that time?
That's right.
So this simplified the life. Well, we went to the bank and they gave us a line of credit, which gave us this little checkbook, which allowed us with that checkbook to be able to immediately take advantages of opportunities. Now,
I like that little checkbook. That's cute how you did that.
You like that? Yeah, it's so good. For those who are not watching, I am the worst drawer. But because I have that, it simplified my life to be able to make financial decisions immediately. And I could do wires or ACHs or whatever I needed to out of there. Well, here's where we understood what the risk potentially was. What happens if this bank files for bankruptcy, right? Whether it's Chapter 7, Chapter 11, 13, whatever it may be. If they go into bankruptcy of any sort, now this collateral assignment exists. And I'm just going to use, let's say that we have, $5 million and cash values over here in our life insurance contracts. So we over here, the bank won't give us all access to all 5 million, but maybe they gave us 4.8 million worth of lines of credit, right? So this is our line of credit available or not available. This is our credit limit, right? 4.8 million. And then if maybe we've been taking out loans, and so we have loans outstanding for, 2 million. So our available credit would be the difference between the 4.8, right, and the 2 million. So for those keeping track at home, that's 2.8 million staying. Now, if this bank goes into Chapter 11, what happens? I can't go back to this insurance company and say, hey, I have a loan with these banks for $2 million. But they're, I can't write any more checks against my checkbook over here because they've shut the doors and they've closed access to those accounts for right now.
Right.
But I have another 2.8 million and I have this investment opportunity. I want to go ahead and take a loan against the insurance cash values I have over here. What are they going to say?
Do it now.
Good. I hope you guys are listening better than my co-host at this point. Good gravy, man.
I'm sorry. Catch me up.
What they're going to say is, I'm sorry, you have a collateral assignment against that says we have to check with this bank first before we can issue out any loans against your contract. Now, why would they do that? Why does that exist at the insurance company? Why do they have to go to whoever the collateral assignment is against it before they could give us, the owner of the insurance contract, access to any more money?
Because they don't want it to be double dipped, so to speak.
Right. If we had all $4.8 million loaned out and we came over here and got another $1 million in loans, now we've got 5.8 million out, but only 5 million total value.
Right.
They would be upside down. Remember, insurance cannot lend out more money than what they have on deposit.
100%.
We cannot borrow money against our life insurance policy that does not exist. So when people talk about how do they use infinite banking, you have to have the money there. So that's the first reason why we have to understand the risk that exists when we're using lines of credit, is that if this bank goes under, it doesn't matter how much we have available over here on our line. We have to assume the bank is going, or the insurance company is going to assume every dollar has been out. And until that bank is operational and can confirm or allow us to release this line of credit, which all that means would, if we had a $2 million loan, the bank would take a a $2 million loan against our life insurance contract value and send it to this bank, eliminating that loan, putting the loan on the insurance company or against our life insurance policies, and now we're released, which again, if somebody is working at the bank and can process that, that happens. So here's a couple of things which you were just talking about. One is that what you found is that the guy who had been working at a bank that was, a sister bank to one that went under said, actually what happened when that bank failed, everything continued as normal. There was a couple of day process where they were having to transfer it over to a new bank that came in and took them over. Is that a big issue for us? No, it's not a big issue. That would be simple. Another thing I heard is, think about whoever's taking over this bank, they need cash. So if we go to the bank and say, hey, we want to go ahead and pay you $2 million and take this loan off your books, that takes a loan off the books, liability goes down, and we give you cash, asset goes up. That would make sense. They would want to do that. So I believe it's not a major problem, but we needed to understand what that risk was, and we want to make sure we verbalize it to you because we don't know, right? I mean, who knows how long it takes for that bank to be operational? And if we don't know, that could be a problem.
Exactly. So we'll keep you updated as we unravel this and learn more, but we want to at least give you a heads up. Now, we're almost out of time, Russ, and we haven't talked at all about what does that mean with all this uncertainty in the market. What does it mean for us in terms of passive income going forward? And what do you think people can do in light of it? So I think the first thing that I'll do is I'll quickly share with you our report from February. And I'm not going to go into detail, like super detail, but I'm going to just give you the high level. Our land business continues to be amazing. We're sitting at net income from that. Gross income, $24,921. Net income, $17,444. This is at thelandgeek.com. If you haven't already learned how to flip land, it is an amazing process. We have it done for us by the Land Geek team. And you can get more information there if you want to learn more. But to me, this is the most solid thing that we do because it is hard assets that are tied to collateralized loans. And so we just got done talking about how a bank collateralizes these insurance policies and does a loan, and they feel really confident about it. I feel really confident thinking like the bank when we're collateralized against raw land, because what happens going forward if we see a major financial crisis here and people are having trouble paying us back on these land loans? What would happen to us, Russ?
We would take the land back, which would be reducing how much our cost basis. So we paid, $5,000 for it, and they paid us $1,000 back, and they default. Now we take it back over, and we go back and again sell it for $15,000. But now we get to keep the $1,000 that they paid us, and we're going to get the full $15,000 on the new one.
Exactly. Now, we don't predicate our whole business model on the fact of people defaulting, but it happens. And in the event of a major economic collapse of some sort, there will be more defaults, and we will get more of that land back, and we will have a period of time where our income will dip as a result, but we will have all the hard assets to then go back to the marketplace with. That gives me a lot of peace of mind. And that's why one of the strategies this year that you and I are working on is building an additional fund to start to lend to land investors who are having success in the space and allow them to borrow from us, because their biggest concern, their biggest need is they know the process, but their biggest need is for capital, working operational capital, because what they've done is they've taken, let's say, $10,000 worth of capital, went out and bought all these properties, and they've got them now set up on loans coming back to them monthly, and it's trickling back so that they have this immediate need for more capital to keep that process going. And we are in a position where we could do that and just supplement what we've already got with this Done For You land business by doing more of what you know. That to me is the lesson. We love land flipping. It's been successful. how can we do more of that instead of taking on some unnecessary additional risk in the light of uncertainty in the marketplace?
Well, I think there's the point. Whenever there's uncertainty, that means things are going to go on sale.
Yep.
And when things are on sale, in order to purchase them means you have to have access to money, whether it's yours or someone else's. The banks are not going to be lending in the future. Mark it down. The days of easy money that we've experienced for the last 10 years are gone for a number of months, maybe a number of years. Interest rates are going to continue to stay high for a period of time. That means banks are going to be tight. They're not going to be lending against it. They're going to be encouraging deposits. They have to have those deposits. Otherwise, that margin is going to get worse. That debt to equity ratio is going to get greater, right? So we know that that's the truth. So we better find ways to grab capital. Well, those who have built a land business that are out there buying properties, they know people are getting antsy, and now they're going to start to experience most likely a higher number of people willing to sell just so that those people can get cash and put it in their pocket. And so they're going to see their acceptance ratio on the number of mail outs increasing. I'm already seeing it. I had a guy reach out to me the other day, said, hey, I got 8 properties that I can buy. I just don't have the cash. And I'm like, I can help you, right? Because here's the thing, is that we have cash. If you've been doing infinite banking for any length of time, you've been stacking cash, right? But what we want to do is create financial freedom. That means we have to turn cash into cash flow.
Right.
Well, for us, because our experience is in this area, it gives us the ability to then take that cash, fund deals for people, and get the cash flow, participate with them on the cash coming back as they sell them to be able to win. And I think as you look at our list here, there's lots of different things that we're doing, but it really irrelevant to what you're doing. You need to find areas in which you already have experience in and either go deeper in that or find little spin-offs of it, like what we're getting ready to do in the short-term rental space, Joey.
That's right. Yeah. The thing I was going to point out about that is that this is a area that you and I have invested a lot of time and energy and education in understanding the short-term rental market, understanding different models of short-term rentals. And so for us, we want to focus now on going out and purchasing properties that meet our criteria of what we think the short-term rental business is going towards. And that's going to be larger homes in the Birmingham area and potentially some other destination locations, right? Lakes, beaches, mountains, so on and so forth. But we're going to look for ways to take advantage of the market where people could either sell it to us on subject to terms, owner financing, other creative ways that we can get the best possible deals on those properties, and then use our short-term rental experience to take it to the next level. That is a real focus for us over the next 24 months, is to keep our eyes out for that. And as you can see, in the month of February, we netted all in with the 25 units that we had. February is a historically really low month. We netted just under about 5,000 after all expenses paid for that business. But really looking forward to March, April, May. It's definitely increasing as far as our local market.
Well, and I think this gives us a way to go out there, and we're making a switch personally out of arbitrage to owning real estate, as Joey said, as we find ways, because we know banks are not going to lend, right? We're not going to go out and buy homes the typical way using conventional financing, because it's going to be harder to get that money. For anybody, it's going to be harder. So we're going to find properties where people need to get out from under them, and those will be the properties we will pick up subject to or seller finance. So that way we're not with the bank. We're not having to worry about the credit limits out there, and then taking those specific properties that meet our very tight criteria and putting them into our short-term rental portfolio. We know that there's a lot of information out there for you to follow. We are always thankful that you come here and you listen to things that we're sharing, but you've got to understand what your investor DNA is. You got to understand what your investor buy box is. You got to build out a plan. And most importantly, you have to be in community with other people who are doing this. I'm going to call you to action. If you go to wealthwithoutwallstreet.com/free call, we have coaches that set up 15-minute free calls for you that they can help better understand your situation and determine whether or not we need to strategize in a way to help you figure out what the next right thing is for you, or point you to a resource that we've already created to give you the feedback so that maybe that's the next thing for you. So go to wealthwithoutwallstreet.com/free call and take advantage of that. Stallion, thank you for jumping on here. Sorry, I went a little long-winded. Hopefully that's some value in my drawing, even though you weren't listening.
That is my fault. I'm sorry. I was not paying attention there earlier. To sum everything up, this month, in the month of February 2023, we netted just over $60,000 in our passive income. And that is something that is a little bit higher than what it was last month. We were at 38,000 in January. And so looking forward to this year to try to add more and more value to this report, getting more creative in light of some of the uncertainty. We hope that this is valuable to you, like that this is something that you will take action on and not get caught reacting to the market all the time, right? Having a plan, like Russ said, and getting very clear on what's your position is going to be going forward. That's what we're about. That's what we want to continue to share this with you, not because we're perfect or we have it all figured out, but because we want to be one beggar telling another beggar where to find the bread. Like that's exactly how we think about this. And hopefully you've gained value today. Anything else you want to add before we shut this down today, Russ?
No, man. Let's get to the next podcast. Hope you'll keep listening. Have an amazing day.